So what do we have? The first rates on your screen, 15 points, 12 points, 25,023, now in the red. So it's like pretty similar to the kind of open we had yesterday, the kind of market we had yesterday. Although through the course of the day, you had, I think, 3-4 of these 40-point bumps which got sold into. So we'll see if that we have some similar kind of session. Nothing, 3 or 3.5 odd point change. We've got the Sensex, which is up about 25 points, 81,733. The Bank Nifty is down about 100 points, 51,174. The IT index is up about 155 points, which is about 1/3%. So that's essentially what you have right at the word go. And, what 4:1 in terms of advances to decline ratio at this point. But all about stocks, so let's take it to what's happening.
I checked out BSE at the start just to see if the excitement is even rubbing off, and it is. BSE started about 3% on the higher side, and actually some of the headline makers, NBCC, we flagged off this stock because of the bonus that the company is looking at, 6% higher, and Office is the other one. Keep your eye out on this one, on the big deal that they've signed for their expansion, 6% here. But anyway, back to the large cap screen. That's about 14 up on the Nifty right now. LTI, Mindtree, Wipro, Infosys. So it's technology to begin with. That's where the big buying seems to be. M&M seems to be putting on about 0.7% as well. There's Cipla in the mix. Bajaj Finance is trying to build on yesterday's gains and momentum, but actually then it's fizzling out. Reliance is just at the borderline with a gain of about 9 to 10 rupees at this point in time, and then it completely fizzles out. On the downside, Shriram Finance, after yesterday's big rallies, losing about 0.5%. Divi's, Axis Bank, these are some of the other stocks on the way down. Ultratech Cement, ONGC, and the two-wheeler guys, Hero Moto and Eicher, are starting lower. Bajaj is absolutely flat. So safe to say that it's almost impossible to highlight any trend, barring the fact that there's some buying in large cap IT that's evident. Everything else is either flat or listless. LTI Mindtree is really piling on the gain now, 2.5% on the upside. The Wipro, Infosys I mentioned. Let's just see if TCS is. No, TCS is actually not part of the upside, at least as of now. HCL Tech is, but overall, IT leading from the front, 22 points up on the Nifty.
Well, that's right, Surbhi. I know the one that's moving like a bazooka is Datamatics. Yesterday, the stock was up 20%. They had announced they're partnering with Microsoft to develop its own AI-focused Copilot solutions. So that one is again up close to around 9%. Big up move is what we're seeing on that counter. You have Tata Elxsi. That's pulling back a little bit. I'm looking at a Kotak note. They said that the company is excellent, but valuations are inflated. Valuations are around 61 times its forward earnings. They believe that, it's stretched, and that's why they have retained their sell rating out there. So Tata Elxsi is pulling back a little bit. GMM Pfaudler, large trade, 8% equity changing hands in pre-open. The street likes that the deal is out of the way. We'll have to find out who exactly is part of that deal. But for the time being, just take a look at that. A big up move is what we're seeing out there. A rank underperformer, down 10% in the last 1 year or so. But for the time being, it's pulling back some of those losses. A couple of other big movers. Trent is moved up by close to around 2%. It's bracing to get into the Nifty. The official announcement has already come in there. So bulk of those flows have taken place. But now, in the next couple of weeks, we'll have Trent that moves in as well. On the flip side, RBL Bank down close to around 1.5%. Aarti Industries is down close to around 1%. I think we're an hour or couple of hours or so away from those fresh all-time highs. Today is the day.
And NIIT, did you mention? NIIT is finally cooling off. It's had a massive run, almost 45-50% in just a couple of days. A little bit of a cool-off today, 4% lower.
All right, we've got about 20 points on the Nifty. 25,040 is where we are at. And we'll have the rates coming up. We should look back at the indices as well. Market breadth is positive, about 2.5:1 in favor of advances right now. I think, apart from what we've already mentioned, IFCI is up about 4%, so about 74. It's got very large volumes. BLS is up about 3.5%, 450 on BLS. We got Infi Beam, which is coming up with a 2.5%, I think can be safely ignored. EMS Limited, 4%, 4.5% higher, 885 on EMS Limited. It's got volumes. Insecticides India is up 9%. Stocks are about 1,010 on Insecticides India. Kiri Industries has been having a fantastic run recently. From the lows of about 300, it's basically added 100 rupees in the last 2 weeks or so. That is Kiri. What else? Aptus Value is up about 3%. But again, volumes are nothing to talk about. So we'll just sort of wait for volumes to pick up. If they do, and then we'll look at some more names here. Tata Elxsi is the big loser. It's down about 3%. Stocks at about 8,700. But you have Hindustan Zinc, which is down about 3.5%. RBL Bank is down about 2.25%. Ola Electric will come up on your screen. That is down about 1% as well. There is K Fintech, which is down about 3%. K Fintech, 1,115. K Fintech, I think, was sort of a mover yesterday on the upside. It's giving up some of those gains. And NIIT, as Surabhi mentioned, is down 4%. But, it's basically gone from $100 to about 107. I mean, yesterday's high, I think, was closer to 180. So that's a sharp 75-80% move very quickly. And today it's giving back about 4% of it. There is Nykaa, Policy Bazaar, Titagarh, Kalyan Jewelers. These are all large liquid names. And they're all down between 1.5% to 2% at this point in time. I mean, it's a quiet kind of a start. You got about, 20 points for the Nifty at about 25,040 or so. So that is some price action which is coming through. I think let's just look at the L&T tech stock as well. And let's go back and sort of revisit it in terms of what's going on there. Stock's up about 2.25%. Rima, tell us more.
So the key takeaway in their analyst meet yesterday is that in the medium term, the company wants to achieve a revenue, annualized revenue run rate of $2 billion and expand margins to 17 to 18%. After that, after they achieve this ambition, the company has said that in the three verticals which they're focusing on, mobility, tech and sustainability, the company wants to achieve $1 billion each in terms of revenues with a focus on expansion in margins. So the company has laid out this strategy to achieve this growth target, and L&T Tech has been a bit of an underperformer. Particularly what the street like is that, say you always compare L&T Tech to a KPIT Tech. Now, KPIT Tech has been outperforming because it's present in the automotive software development vehicles where there is a lot of offshoring work taking place, and KPIT Tech has been a beneficiary. Now, analysts' contention was that LTTS is a diversified play, but it's not present in this high-growth automotive, software development space. So yesterday, the management did spend time on it. They're calling it out as a focus area, and they've, revamped their go-to-market strategy to try and target some of these high-growth areas. So Motilal Oswal came back quite bullish. They have said that this revamped go-to-market strategy opens up new avenues for growth in the hitherto weak areas such as mobility, which is growing fast across peers. Their target price stands at 6,300, a close to 12-13% upside from where the stock currently is. Nuvama says that growth is fine, but the stock is a bit expensive valuations-wise, so therefore the risk-reward is unfavorable. They have a hold rating on the stock, but the key takeaway from the analyst meet is that the company is focusing on getting growth back and focus is also on margin expansion. Back to you.
Okay, all right. Rima, thank you very much for that. Well, Pankaj Tibrewal is with us, founder and CIO at Ikigai Asset Managers. Pankaj, good morning. Great to have you with us here. Thanks very much. And it's a sort of incredible sort of market back at new highs. Lots to talk about. Pankaj, and that note that you sent out, right? I mean, learnings from 2 decades of investing. It's a fantastic write-up, and I think everybody should read it. You should make it sort of public on your website because it's quite rich in what new investors can take away from it. And one particular bit struck me: self-control in investing, the opposite of FOMO. Our market's a bit out of control right now. How would you read things, Pankaj? Especially in mid caps, smaller caps, especially SMEs, etc. What's going on?
Good morning, Prashant, and thank you for the kind words. On the markets, I think it's incredible last 3 weeks, from panic to euphoria. We saw Nikkei being sold off almost 20%, and now they are up 23% from their recent lows. S&P is almost 1% away from all-time high, and so are Indian markets now. So it's been complete panic to euphoria in last 3 weeks. But when I look at some of the data points, firstly on the earnings side, I think this quarter was not a great one as far as earnings are concerned. And I look at the data very closely. The NSE 500 companies reported 7% earnings growth on a headline basis. But when you bifurcate it into two parts, which is BFSI and the non-BFSI segment, there are about 89 companies on the BFSI segment which delivered 19% earnings growth. But the non-BFSI segment, which is the rest 411 companies, delivered just 1% earnings growth. So clearly there has been deceleration in terms of earnings growth. And our belief is that the first half would be weak as far corporate India is concerned on the earnings growth because margin base is quite high. The second important part to note is that most of the companies mentioned elections and heat wave as the constraint in the first quarter, to the extent that elections were mentioned 1,700 times in the NSE 500 con calls, and heat wave was mentioned as more than 100 times in the con call. So clearly, we have to see that how the second and the third quarter spans out. Third important point to note is that the government capex is down by 35% in the first quarter. That means for the remainder of the 9 months, government needs to spend 1 lakh crores a month to cover their budgeted numbers, which looks to be a tall task, not an impossible task, but a tall task. And hence you have seen some sell-off in the exuberant names or pockets of excessive valuation, like defense, like railways, like infrastructure. Some of the capital goods have given away 20 to 25% returns. So my sense is that over a period of time, we need to avoid the pockets of exuberance. There are certain segments which probably are looking reasonably okay, but we need to navigate next 6 to 12 months carefully. I think this is a period where you should minimize risk rather than maximize return. I think that should be the trend. Also, one interesting point which we are noticing is that the breadth of the market has started to narrow down. Over the last 20 days, we have seen large caps doing slightly better than the mid and small caps, and sector rotation is happening at a faster pace. So I think a diversified portfolio will be the order of the day, and risk should be managed in a fairly decent manner. Second, on flows, I think some interesting data points there to notice out. Though domestic flows have been extremely strong over the last 4 years, we have seen about $100 billion of domestic flows. But something to note interesting out there, in the first 7-8 months in calendar year 24, 80,000 crores have come into sectoral and thematic funds out of the 2 lakh crores on mutual funds. This is a slightly worrisome sign because people are chasing returns. And don't forget, Prashant, that 50% of the mutual fund investor base now is 3 years old. That means they have seen one-way market. How they will behave when they see a 12 to 18 month sideways or a consolidating markets is yet to be tested. So don't take domestic flows for granted, on which the entire thesis and narrative is getting based on.
Pankaj, hi, good morning, and great to have you on the show. Good to be listening to your viewpoints. Just a word on thematics, right? Let me argue for the other side as well. Very true that people are chasing returns, but it's also the asset managers, right? Because that's where you can create new products. That's where you can bring new stuff to the market, add a little bit of marketing razzmatazz. So that's what's getting sold, and that's where the money flow is really coming in. But yeah, absolutely take your larger point. There is something to be a little concerned about, depending on how people are bifurcating their portfolios. But on to the point that you just made about this is the time to minimize risk and not chase returns. So let's talk about maybe profit taking. Nobody talks about profit taking. The time to sell, the time to lighten positions a bit. I know that across the mutual fund industry, I think cash levels have been rising 6, 7, 8%, some even higher. But at an individual level, where should one start trimming positions?
Surabhi, I think one regime change which we are seeing in the market over the last few months is that momentum and value, which was the classic trade for the last 2 years, 2.5 years, is slightly taking a backseat. And quality and some of the names on FMCG consumer are coming back. So that's a rotational trade or a regime change we are seeing in the marketplace right now. On the cash calls, I think from a risk minimization, I've always believed that cash is a double-edged sword. You can get one trade right one way, but to get both the trades right, it's a very, very difficult task. Maybe you may be very lucky. I don't possess that skill set at all, and I'm very realistic about my abilities in life. And I believe that portfolio construction is the key to survival in the markets. Over a period of time, nobody can predict future. I think Fed doesn't know what the interest rates will be or inflation. I think only thing which is in our control is our own temperament and emotion. And the second thing, how we construct a portfolio. At this stage, I believe that a concentrated portfolio could be at risk. I think a diversified portfolio across sectors and stocks and across good quality companies should be the order of the day. We should be taking out money from companies where there has been excessive valuation, where there is narrative at play. Many places we have seen that markets are pricing in irrational exuberance out there in terms of expectation. And clearly, if you do a reverse DCF in many names, you will find that the valuations you can't justify. So I think rather than getting carried away by the momentum at the near place, we should take a fundamental call and trim positions where the valuations are in exuberance there.
But I know, Pankaj, I know you can't get into stocks, but at least name the pockets, for the benefit of viewers. When you say excessive valuations, pricing in the moon and back, what are you referring to? Is it capital goods? Is it defense? Is it PSUs? So some idea and some hints that, viewers can perhaps hold on to.
So Surabhi, look at this data point. This railways and defense combined market cap is 18 lakh crores today. 5 years back, this market cap was 1.2 lakh crores. So from 1.2 lakh crores, you have gone up to 18 lakh crores, which is 15x, which means 67% CAGR over the last 5 years. When you look at the profit growth, it's about 21% CAGR. So you have clearly seen expansion on multiples led by various narratives and delivery by the companies. But is it very high? Because finally, most of these businesses depend on one customer, one policymaker. Should it demand such kind of valuation is the question we need to ask. So I believe that there are certain pockets like this. I'm giving you one example where from 1.2 lakh crores, the combined market cap has moved to 18 lakh crores. Profits have not kept pace. They are at 20% CAGR. Market cap CAGR is 67%. So similarly, in many other pockets, probably when fundamentals, stock prices are running ahead of fundamentals, we need to take a reflection and try and trim position and manage risk out there. These are the pockets where I mean by excessive valuation.
Okay, very, very helpful. Thank you so much for spelling that out, Pankaj. I think it's, it's important to listen to prudent voices at this point in time and not get completely carried away. Great having you on the show. Thank you for making time for us this morning. Well, that's a view from Pankaj Tibrewal. The market, meanwhile, has turned negative. Just keep an eye out on the screen as well, about 35 points lower on the Nifty. And the banks are not really stepping up. That's the issue. The Bank Nifty is falling. Some of the financials that had rallied yesterday, they're correcting. So right now, it's a bit of a sell down that we are looking at. Well, let's continue with the corporate conversations then. The next company on our radar is Reach Shipbuilders. The stock has surged more than 100% this year so far. The company has reported a strong set of numbers for the first quarter. Revenue growth has been quite robust. Margins, of course, dipped a little bit in Q1 because of the high cost of materials. So to talk about the business outlook going forward, we have with us PR Hari, Chairman and MD at Reach Shipbuilders. Mr. Hari, thank you so much for joining in. Great to have you on, sir. So I'll start with, the guidance that you've spelled out, and it's sort of 25% growth. I think that's what you're expecting this year. Let me just quickly rewind back and check the order book. I think as of June, you told us that your order book was just above 25,000 crores, 25,200. So tell us now, we're in the second quarter. How aggressive is the bid pipeline? How much will you grow this order book by? And are you still confident of delivering 25% revenue growth?
Morning, Surabhi. Thank you. Yes, our order book currently stands at 25,231 crores. And 90% of this order book comprises of shipbuilding orders. That is our main business vertical. And balance 10%, around 10% come from our other verticals like marine diesel engines, ship repairs, and so on. Now, when we started the financial year, our order book was 22,600, approximately 22,600 crores. And the order book is actually increased. Now, this order book, I'm just coming to the shipbuilding segment. This order book of shipbuilding comprises of 29 platforms for 10 projects. 4 of these projects are being executed for the Navy. And the balance 6 projects include 3 export orders, including for a commercial order that we got from a German client. Now, this is a current order book. in the next 3 to 6 months, we are in the negotiation stage for concluding another 4 contracts for 20 platforms. This is the short-term future that I'm indicating. Now, we also bid for the next generation corvette project for the Indian Navy. This is a very, very high value order. The total order value is a 8-ship project, and the AO in itself is around 36,000 crores. And we expect the bid results to be declared in another 4 months. In addition to that, the Navy is also expected to come out in the next 1 year RFPs for 2 multipurpose vessels, and the Coast Guard is likely to come up with an RFP for 6 next generation ocean-going patrol vessels. So I've just given you an overview of our current order book and also what is likely to be in the immediate future.
Right. Got that. Mr. Hari, hi, good morning. Prashant here. There's a lot of things to get our head around. So let's just take it one by one. When you say platforms for our viewers, you essentially mean ships, vessels?
Yes, absolutely correct. Ships. When I said we are building 4 platforms for our German clients, that means 4 multipurpose vessels for a German client. And similarly, we are, to answer your question, yes, platforms means ships.
Okay, because you do frigates and ships, all kinds of things, right? Yes. So just a quick thing. So you're saying in the next 3 to 6 months, you are close to concluding orders worth how much? What is the size?
The size is approximately between 1,500 to 2,000 crores. The contract negotiations are currently in progress. We have been declared L1, and we expect a conservative time of 3 to 6 months for conclusion of these contracts. These include an export order also.
Got it. 1,000 to 1,500 crores in the next 3 to 6 months.
Between 1,500 to 2,000 crores. The negotiations are currently in progress.
Okay. The bigger one is going to be that corvette negotiations with Navy, right? Which you said in totality is about 36,000 crores.
It's a 8-ship project. In totality, it's around 36,000 crores. It will be 36,000 plus crores. And this order will be split between 2 shipyards, with the L1 shipyard getting 5 ships and the second shipyard getting 3 ships. So we stand a good chance of getting this order, considering our experience and expertise in building corvettes. So
6 and 2. 6 and 2.
5 and 3.
5 and 3. Okay. But so you will get something, right?
That's what we are expecting.
You could get 5 or you could get 3, but you are assured of.
We'll definitely be targeting 5.
And this will conclude this year in FY25?
In a normal order processing stage, from the time the L1 is declared, then the contract negotiations happen. So I don't expect the contract to be signed during the current financial year, maybe in the first quarter of the next financial year.
But sir, just to complete this order book picture, how much of the order book is naval right now as a percentage? And now that this big contract is coming up, realistically speaking, how will that number move? Just trying to understand. And then you're doing ocean-going vessels and platforms, for instance, for this German entity. So just want to get the order book mix between naval, non-naval, and some of the export orders to understand where you get better margins. I'm guessing some of the export orders fetch you better margins?
I'll just give the approximate breakup now. As I mentioned, our total order book, around 90% of the total order book comes from shipbuilding. Of this 90%, if you just take the shipbuilding orders, around 85 to 90% still come from Indian domestic warship building orders. That is our primary focus. I'll just give you from a different perspective. Now, you see a commercial ship of 10,000 ton, let us say, displacement, and a warship of 1,500 ton displacement. The order value for the 1,500 ton displacement warship is going to be at least 4 to 5 times more than a commercial vessel. But commercial vessels, definitely the margins are more, and the number of commercial vessels, the platforms are likely to be more. So it's a balance between both. So to answer your question, around 85 to 90% of our shipbuilding order book is comprising of domestic warship building orders. That is both from the Navy and the Coast Guard. Currently,
and is that likely to sustain, sir? Is that likely to sustain at that high level?
Absolutely.
In the next, let's say, next 1 to 2 years, we shouldn't expect a change in the mix, right?
No, we don't expect a change in the mix. Maybe I would even take it further. By next 1 or 2 years, I will take it to the next 5 to 10 years. The same ratio is likely to maintain.
Okay, all right. Hi, Mr. Hari. Good morning. Let's get a couple of numbers out of the way. Last year, you did around 3,600 crores. So this year, you end at around 4,500 crores. Would that be a fair estimate? And also, I wanted to reconfirm that because you've had such a strong start to the year. And what is the margin we should work with?
Thank you, Nigel. Pleasure interacting with you again. Yes, I had mentioned that we'll be maintaining a CAGR of around 25%. We're very confident of maintaining a similar growth. In effect, what you're telling is correct, plus whatever figure you mentioned, plus that figure we'll be able to achieve. As far as the margins are concerned, as what Surabhi brought out, there has been a slight dip in our margins, but we are very confident of maintaining margins that we had, PAT margins, what we had indicated earlier, plus 8% in the coming quarters and years.
All right. So PAT margins would be at 8%. Got it. Mr. Hari, also, if you could tell us what is the current utilization levels? I recall you telling us that the shipbuilding capacity was around 20 warships and you were looking to increase it to around 24. Has that happened? And what about the capex that you'll be incurring for this year?
Thank you. Very interesting question. Yes, I wanted to make a statement that our shipbuilding capacity was 20 ships, but considering the current order book and the expanding number of platforms that we are going to execute, we have invested, we have done capital infusion and enhanced this capacity to concurrent construction of 24 ships. As of now, our current construction capacity is for 24 ships. What we also done is segregated the ship repair operations out of our physical premises. We have taken a facility outside our premises and we are doing a complete ship repair operations from that facility. In addition, if we get more orders, we also adopted and successfully adopted a strategy of public-private partnership where we utilize the spare capacity of capable shipyards to undertake construction of ships. As far as capital infusion, yes, we have been steadily pumping in capital. We had undertaken a massive infrastructure augmentation during the mid-2015, 2020 period. After that, every year we infuse capital in a strategic manner, which means basically to revitalize the facilities, procure new equipment, new technology equipment. So steady capital infusion is happening and current capacity stands at 24 ships, 8 large and 16 small and medium ships.
Right, and this will stay at 24 after the expansion, Mr. Hari, right? I mean, this is
No. Again, an interesting question. What we felt was we will go in a phased manner. We have also taken a facility or a strategic partnership on the West Coast, which currently is not utilized yet. So what I mean to say is that 24 ships within our premises, ship repair facility completely segregated, public-private partnership both on the West and East Coast. And we intend increasing this capacity in the next 3 years to concurrent construction of 26 ships. That is captive facility.
In the next 3 years to 26 ships.
That is within our premise, affirmative.
Got that. Just two other brief questions on the revenue thing, just to stretch that time horizon a little further. I think you had indicated you intend to get to 10,000 crores in revenues by FY28. I mean, it's a slightly away target, but you will have visibility for that. Are you sticking with that as well?
I would like to make a very slight correction. What we had mentioned was to touch 10,000 by 2030. That is our stated vision, to touch a revenue crossing 2030. And if you just see our current order book, the current order book, including the small orders that are on the anvil, I mentioned about 1,500 to 2,000, they all will get exhausted by 2029. And if we get the next generation Corvette order and a couple of big orders that are coming from the Navy, we will definitely be able to cross 10,000 threshold by 2030.
Okay, all right, fair enough. Got that. And you've also started. You got into weapons manufacturing. Is that? How do you see prospects for that, or do you think it'll largely be shipbuilding and ship repair, or is it a fast-growing segment?
See, yes, it's true that we have got into manufacturing of weapons. This is a segment that we see opportunities. Adequate opportunities in the future, but our primary focus, I repeat, will remain on domestic warship building with ship repair as a subsidiary segment. considering that weapon manufacturing is an attractive area where the returns are likely to be high, we will provide adequate impetus on this area also. We expect more orders on this segment in the coming years.
All right,
Okay.
we'll leave it there. Thank you very much, Mr. Hari, for joining us. And, it's always great speaking with you. Thank you very much for being here on CNBC TV18. Markets down about 35 points now. And we're at about 24,980 at this point in time. I mean, Garden Reach is up about 0.5%, but it's come off from its highs of about 2,800 to the 1,700 levels, where it is trading, 1,800 nearly, where it is trading at this point in time. We'll take a quick commercial break here, and we'll come back with the management of Gravita India. That's the next management. Interesting conversation with Naveen Prakash Sharma, ED of the company. Stay with us.
Welcome back. Well, keep an eye out on a few stocks. There is this buzz or this hope that NSE will list in the future. And that's why you have IFCI. I think you normally have a sentimental rub-off out there. So that stock as well is spiking up. It's moving on large volumes. I'm presuming it has something to do with this. And also you have New India Insurance. I'm just looking at the shareholding pattern. And they have shares worth close to around 4,000 crores at current reckoning. So that's another stock that you should be keeping on your radar. It explains why that stock is spiking up as we speak, up close to around 2% or thereabouts. They have roughly around 70 lakh shares. And at current market price, well, it could be worth close to around 5,000 crores. So a couple of these names are moving. I think GIC as well has some stake in the company. So IFCI, you have New India Insurance, GIC, all of them buzzing a little bit as we speak at the high point of the day. Well, Gravita, that's the stock in focus. The street is bullish on recycling industry. The stock has surged more than 90% in this year. In fact, Motilal Oswal, they've initiated coverage on the stock with a buy rating. To discuss this and more, we're joined by Mr. Naveen Sharma, the ED of the company. Hi, Mr. Sharma, good morning and good to see you. And as always, well, give us a couple of basic numbers first. There are a lot of triggers, a lot of industry tailwinds as well. What's the volume growth you're looking at for this year? And break it up for us, how much you're expecting in your core business, which is your lead business and the non-lead business.
Morning, Nigel. We are growing with a volume growth of almost 25% CAGR, and that will be a rolling average for next 4 to 5 years as well. While on the PAT side, we are going at the rate of 35% CAGR. Currently, our lead business is almost 88% of the total, which we plan to reduce in time to come to 70%. And we are also entering in rubber recycling, lithium battery recycling, and also increase volume in non-lead like aluminum recycling business. So altogether, we will keep continuing this rolling average of 25% CAGR volume growth in time to come.
Mr. Sharma, from 88%, lead will come down to around 70%. By when? Because I recall you telling us steel and the iron business, that will gradually come in, I think, in the next year itself. That's for FY 26-27. So by when does it come down to 70%?
Right. So it will be coming in next 3 years, the steel and paper business, but the other business, rubber recycling and volume growth, which is coming in aluminum business and lithium business, that will certainly reduce these number initially to 80% and later, maybe third and fourth year, it will come down to 70%.
Got it. All right. How big can the aluminum business scale up to, Mr. Sharma? I ask you this because one of the triggers is aluminum alloy derivative is to be launched on the MCX. Explain to us, how does this benefit you? Maybe, the raw material you procure and then you can hedge it at the current price itself once this is launched. Explain to us what is the benefit and how big can the aluminum part of your business become?
Right. So this aluminum business has an equal potential to grow like lead business. And when it comes to aluminum alloy derivative on MCX, this will certainly help in price discovery for auto sector. As of now, because auto sector uses secondary aluminum alloy only, 90% demand from auto sector is of the secondary alloy. And most of the raw material is from import. So as of now, a recycler cannot hedge their material. Auto ancillaries or OEM cannot hedge their raw material supplies. So it will help three ways. Auto industry can hedge material. Recycler can hedge their raw material scrap, which they are mostly importing. And there will be price discovery as well. Because as of now, being a secondary material, there is no such price discovery and there is various variations in the price. And one more interesting thing, Nigel, which is coming in this sector is EPR on non-ferrous metal. Government of India has announced that there will be a draft rule from April 25, wherein aluminum, copper, and zinc, three metals will also come under EPR. So there will be a mandatory 5% non-recycling material content in the finished goods. So it will increase a demand of around 200,000 tons of aluminum from the secondary segment. So it will also give value addition for the secondary material as compared to primary materials. So altogether, I foresee that this segment will grow with the help of EPR on non-ferrous metal by hedging through MCX by launching this derivative of aluminum alloy.
What is the capacity currently in the aluminum part of the business? 70,000 approximately, and you're expecting to increase it by multiple times. So where is it headed?
So as of now, our capacity is around 40,000 tons, and we can certainly increase in no time because we have an in-house facility for adding capacity. We have our project division, so we can add it to 70 or 80,000 in 2 to 3 years based on the outcome which is coming by way of EPR and MCX derivative launch.
Okay.
Right. Mr. Sharma, hi, morning. The markets, of course, have loved the story of Gravita because stock is up. Stock has doubled from May of this year, basically in the last 3 months. It's a doubler, so one of the best performers. Could you tell us, just two basic questions for the uninitiated who've not really followed the stock that much. Have there been specific regulatory changes which have kind of driven a marked shift for you and acted as a tailwind? And second, what are some of the risks, since you are in the recycling business, which is, of course, what needs to be done, recycle and reuse. So these are big buzzwords around the globe. But are there any risks as well on the regulatory side as you see it? Go on, sir.
Hi, Prashant. So basically, of late, there are various regulations which has come. Government has come with EPR, battery waste management rules have come. So lead business has grown multifold because of that. Parallelly, government has come on tire recycling policy, tire waste management rule, plastic waste management rule, oil waste management rule, and e-waste management rule. So all these rules have shifted a lot of, we were telling always that this sector is informal sector to the extent of 65 to 70%. So there is a great shift from informal sector to formal sectors. So, and Ministry of Environment has brought various regulations, and they are also bringing, as I mentioned earlier, that they will bring the same regulations of EPR on non-ferrous metals. So it is altogether a sunrise sector, and with these regulations get implemented, EPR penalties or ECs are being implemented, it will grow multifold. So I do not foresee any such other threat to this industry, though this is being a hazardous waste. So we being a technology provider also have edge over other competitors because we have in-house technology and we are exporting our technology of recycling to various countries. So we do not foresee any threat to this sector, and it will keep growing because of ESG requirements, sustainability, and zero carbon regime, which is coming in time to come.
Okay, all right. Final question, sir. We're running a little short on time, but help us out with a few details. What is the current consolidated EBITDA per ton, if you can help us out with that number? And what should be the margin we should work with from here on?
So in rupee terms, it is 15 to 17 rupees a kg, and in percentage terms, it is around 9 to 10%.
15 to 17 rupees per kg, where is it headed?
It will be headed with a growth of around 8 to 10% as we add to value-added products further, because as of now, our VAP product is 42%, which we plan to go to 50% in time to come.
All right. We'll leave it there. Thank you very much for joining us. Appreciate you being here, and interesting business. And you've got all the tailwinds going for you. I mean, as they say, the stars align, and they have aligned for your business, and it looks pretty good. I mean, at least the overall argument that you can make for the business and the continued growth, I think remains pretty solid. But stock's done very well. As I said, 3 months, stock's doubled. Shriram Finance is the next management of the program. The stock has surged more than 60% this year. Again, for Shriram Finance, the last year and a half, 2 years have been a story of complete re-rating. Citi, the brokerage, is a buy rating of the stock. They believe Shriram Finance is defying seasonality and peer trends. Let's talk more about this. Mr. Umesh Revankar is Executive Chairman of the company. He's with us to take some questions. Mr. Revankar, good morning. Thank you very much for your time, sir. Prashant this side. So, as we always do, talk to us a little bit about how the quarter so far is panning out across segments for you, sir. Better than what you thought, what we spoke about at the end of the last quarter, or in line? And if you can sort of help with some numbers, that'll be helpful.
Good morning. This quarter, if you look at the business growth, or rather the credit demand, July was little, we had certain headwinds because of excessive rains in certain location. But August, it is improved. So the monsoon is spread across, and that's really helping. The credit demand has improved, plus sentiments have been very positive. So I believe the September would become much better. And also the festive season starts with Ganesh Chaturthi. And normally it's the indicator. Ganesh Chaturthi is time where people do buy new vehicles or new machineries in certain part of the country, not everywhere. Some people postpone it till Dasara. But I think Ganesh Chaturthi being the first week of September, we should be able to do quite well. So to some extent, that manage the July numbers. So overall, I think the numbers are much better. And it is, I think, it is continuation of the first quarter.
Okay. Morning, Mr. Revankar. I'm coming back to the growth numbers in just a bit because the La Nina seems to be really working in our favor, at least the August rains seem to indicate. But what about the cost of money? That seems to be the real rub, isn't it? Has it increased for you, or has it not increased because the CP market doesn't seem to be affected?
No, cost has not really increased. If you look at our first quarter number, we did had Q on Q, there was improvement in cost of borrowing, in the sense it was around 15 basis point improvement. So the same trend is continuing this quarter also. We are not seeing any challenges in raising resources, and it is quite...
No, if you could just explain, the Reserve Bank had increased risk weights on bank loans to NBFCs. Are you saying that that was not a problem because you didn't go to the banks at all, you picked it up from the market? Is that why? How is it that you were not affected by the rise in risk weights?
See, basically what happens is, depends upon the individual NBFCs. Many of the NBFCs became over-dependent on bank. So maybe 60-70% of their borrowing or liabilities were coming from bank. But in our case, we were not. So we have equal spread between a capital market and we are a deposit taking NBFC. Plus, we are able to raise from the bank, and private sector is one area which we are able to create portfolio and do the securitization. So we are very comfortable as far as the raising resources are concerned. So it is not really going to have any impact on us because we have wide sources of raising resources.
Sure, sure. Sir, just to go back to the point on growth, and you're sounding very optimistic with the onset of the festive season. I think you're looking, correct me if I'm wrong, but I think you're looking at 15% AUM growth this year. Just break it up into segments as well, because the MSME segment was really fired up for you, but gold loans are also doing well, two-wheelers, passenger vehicles. I mean, a lot of sectors are really fired up. So how do you expect the trends to be? And this growth is coming, at least as of Q1, at very steady asset quality. So just expand on this. I mean, the growth number, and whether at the margin you're seeing any concerns in terms of delays or delinquencies at all, because we're hearing that from some segments like MFI, etc.
See, basically what's happening is, as far as MSME and gold is concerned, we are reaching to new geographies, because earlier these facilities were mostly in the south and were not much in the rest of the country. We are creating the facilities, or we are reaching out to more bigger geography for MSME and gold. So naturally, the growth will be higher year on year for us, because we are adding more number of outlets for this activity, and it will keep growing. And the two-wheeler part of it, two-wheeler is growing at a double digit, 12 to 15% year on year. And that is also helping us. Both units and price both have increased in the two-wheeler. So that's definitely help us to grow more than 15%. And as far as the passenger vehicle is concerned, there is a lot of activity happening in the private participation in the public transportation, because the investment by the PSU, that's not PSU, public sector, that is the government investment in the transportation is coming down over the period, and therefore there's more demand for private people participating in
private
the
cars.
transportation. So that is helping us to grow. So these are all natural growth that's coming into the business.
Got it. So it explains the numbers, and you're still confident. But just the latter part of my question was: are you confident of continuing these growth rates at pristine asset quality? Because I think your NPAs did not budge at all. About 5.4%, 5.39 gross NPA. Will it remain here, or can you be even more confident of maybe even lowering NPAs by the end of the year?
The gross stage 3 would definitely improve from 5.39 to further. What happens is the entire environment has been very positive. Over the last 5-6 years, if you look at the more adherence to the credit bureau numbers, and everyone is getting tracked, everyone has some credit score, and also there is a discipline built. And when we move from 180 days to 90 days, we have been able to communicate to the customer. And every stage improvement has been communicated to the customer. So customers have been little more financially more disciplined than what they were earlier. But even then, the credit cost for us were around 2% earlier. It will improve by around 10 basis points now. That's all. See, there is not big improvement in credit cost per se. But if you look at the gross stage 3, where the awareness was more important to the customer, that has been provided. And therefore, it is improving Q on Q. I think it will continue to improve for at least another 2-3 quarters, because environment has been very positive.
Got it. Mr. Revankar, would you want to up your growth forecast then? Even in the first quarter, you did 21%, although you guided for 15%. And now you let it slip that you will do more than 15%. So is it closer to 20%? What can we work with?
It will definitely more than 15%, but I don't want to put a number on the growth right now. Okay. But definitely it should be around 20, because we have been growing. In first quarter being good, it should definitely help us to grow at that level.
Okay, I wanted to ask you, the governor made a reference to this unified lending interface. I mean, he's basically speaking about account aggregators now, coming online. Has that made your asset quality superior, your due diligence superior? Do you all use account aggregators?
No, it is a work in progress. We are yet to start using the same.
Oh.
But I think it is going to take time, and it is because this kind of information being available, typically if you look at the fintech companies, they were providing this additional services and along the account aggregators. Now, the usage of account aggregator and sourcing the information from them is something which we have been doing, but not the fullest extent. So that will make, see, one thing is using this, information and building your credit rule engine accordingly. That's one part of it. And the second is the personal interface, what we have with the customer. That is also very important. We believe we need to have both. We can't be just depending on one platform to focus on, because it's after all, you are not just distributing, you are underwriting alone. So that's very important.
No, got it. Yeah, I get your point, sir. Personal interface, which you all have built over the years, will be most important. Very quickly, we are being told to wind up. So just two numbers. What kind of a margin guidance can you give us? And what kind of credit cost guidance?
The margins in the first quarter, it was 8.79. We should be anywhere between 8.8 to 8.9. That should be the margin. And credit cost, we should be just below 2%. So maybe 10 basis point lower than the 2%.
All right. This is going to elate your investors. Thank you very much, Mr. Revankar, for joining us, and a very happy festive season for you. It's kicking off in the first week of September.
Thank you.
Back
All right. No, interesting chat there as always. Mr. Revankar, thank you for joining us. We'll take a quick break here. We are back. Commodities in focus with Manisha when we return. Stay tuned. All right, welcome back. The market's down about 20 points, so it's very, very quiet. Mitesh Thakkar is with us with what he'd want you to do in terms of individual trades. Mitesh, morning again. What's popping up on your screen? What trades? Tell us.
So, Prashant, I have IOC as one of the recommendations. I think that's doing well after about 4 or 5 days of sideways activity. Buy here with a stop at about 172.5. Look for a target of around 183. And the other one is Biocon, and I would want to see the stock get past 360. While the chart is good, there's some good call option of concentration at 360, and today's high is about 360 half. So I would recommend a buy here about 360 half, and then keep a stop at about 353 and look for targets of 380.
Okay, all right, Mitesh got that. Thanks very much. Well, with that, let's head across to Manisha for a roundup of all the commodity market action. Manisha, what's catching your attention today?
Well, it is sugar, because after a very long time, we have seen the prices rebound very strongly. So when you look at the global markets there, we're trading at a 6-week highs, and the raw sugar prices have gained up by nearly 11.5% in matter of last 1 week itself. Well, if you look at the prices itself, we did see 17.5 of a low in the previous week. Prices are trading at a 19.7 right now. So that's the kind of jump up that you've seen in case of raw sugar prices. Of course, from the high of this year, which has been 24.5, we still are much on the lower side there. But the fundamentals really seem to be turning around now. One, there is massive fires in Brazil, which is also the largest producer or exporter of sugar. Almost 25% of world sugar comes in from Brazil. And the crop damage in Sao Paulo really seems to be impacting the prices there. The expectations are that nearly 2,000 fire breaks have led to 60,000 hectares of planted cane impact there. The yields can continue to decline there. As of now, the initial estimate suggests that 5 million tons of cane perhaps could have been impacted because of this. And it's not just about Brazil. You have severe weather also in Thailand, which is also the third largest producer and second biggest exporter in the world. So the Thailand yields could be the lowest in last 13 years, also have had their premium come back in case of prices. Come to India then, and the sugar crop is estimated quite on the stronger side this time around. Monsoon is 3% above normal as of yesterday, and that has been supportive for the Indian markets as well. When you look at the crop estimates for 2023-24, the reserves have been higher side at 9 million tons. There's an excess crop of around 3.6 million tons, which the industry has. And remember, India is not exporting. So while we did export a record quantity in 2022 at 11.1 million tons, it has been 6.11 in the season of 2022-23. And India has restricted exports since October 2023. So the markets will continue to look at those numbers as well. Going forward, when you look at the global markets as well, the expectation from USDA is that we are looking at record numbers across. 2024-25 crop is estimated at 186 million tons, which is a record. Consumption is anticipated at 179 million tons, which also is a record. And the closing stock is expected at the 13-year lows. So these are some facts and figures which also seem to be supporting sugar prices in the trade today.
Manisha, thank you very much for that. We'll take a quick commercial break here. On the other side, it's our segment. It's the economy. My colleague Lata will be speaking with Rajesh Kumar, MD and CEO at TransUnion Civil, to discuss retail loan trends in banks and NBFCs. Stay tuned for that conversation.
Welcome to It's the Economy. The Street has been getting a little worried about asset quality of financial companies. RBI was the first to flag it, actually, when it raised risk weights on unsecured loans last November. Since then, microfinance companies and private banks have been showing some signs of stress. My colleague Abhishek Kothari actually calculated the slippages at private banks. And he says after Q1, it rose by 10.9% quarter on quarter. In fact, they have done worse than PSU banks. Some MFIs have done much worse, and that data will run for you. To get an idea of how retail loan growth, that is a quantity and quality, is progressing, I have with me the ultimate guru of retail asset quality, Rajesh Kumar, Managing Director and CEO of TransUnion CIBIL. Rajesh, good morning, and thank you very much indeed for sparing time for us.
Good morning, Lata. Thank you very much for having me on the show.
Well, you all gave us one report in January, CIBIL, where you clearly showed that both quantity and quality of retail assets was fraying a bit. And quantity obviously was going down because of the Reserve Bank's risk weights. What has been the performance in the first 6 months? Has quantity gone down further, retail loans, and more importantly, quality?
Yeah, Lata, absolutely. I think, first of all, there were very definitive interventions from the Reserve Bank for all the well-known reasons in November last year. So that's obviously led to some remix in terms of product composition on the lending side. And I'm going to use the word moderation in some segments and overall a little more conservative or cautious approach overall. But I think there are a couple of factors at play here. A, obviously, the Reserve Bank policy changes, which are very timely and proactive. And secondly, as we all know, the existing credit deposit ratio, where the ratio is still pretty high. So when the ratio is high and your incremental cost of deposits is higher, obviously it means that you're relooking at your product mix in terms of the desired goals on the net interest margin versus credit cost. So almost every lender is rewriting their product mix and the capital allocation for products. So all of that leads to some of the changes that we're talking about in terms of some change in growth rates at a product level. The change, more importantly, I think some people often ask, is there a decline in the retail loans books, etc.? So the answer to that is the growth rates are pretty much intact. Intact in the sense we are still growing. I mean, India has so much headroom for growth. So we are pretty much growing. It's just that the growth rates have moderated. For example, if a product was growing at, let's say, runaway 30%, that would have moderated to a 20% or 10%. And obviously, the biggest drop is in unsecured loans below 50,000 and credit cards as well. So that's the overall trend in the oh yeah, one other important point, Lata. So when we talk about growth origination, I think it's also important to look at the trend in terms of quarter on quarter, or for the same quarter a year ago, how is the growth rate, right? I think this is super critical because this sets the direction. I say that also from a risk perspective, because invariably delinquency ratios are a function of how the numerator, that is new delinquency, comes in versus incremental book size. So as the latest quarter growth rates are sharper or lower, more low than the previous quarters, then the growth rate of the overall industry retail book will come down. Again, it is still growing, but the growth rate will come down.
Yeah, I've in fact got your table on newly originated loans, and across the board, one can see the reduction. Credit card in particular, April-June 23, 7.8%, and April-June 24 is minus 29.6. So clearly, there are some people who are pulling back. But what about quality? I guess that is the bigger fear. Retail is still the trade, the go-to trade. I have not heard any banker trying to sing praise of corporate credit just yet. It's a very crowded space. NBFCs, banks, P2P lenders, fintechs, everyone is in the retail trade. So are you seeing in the last 6 months more worsening of asset quality?
Actually, no. I think we have some good news through all of this. I know last year we spoke about some stress in the very small ticket personal loans, etc. But like I said, the timely interventions, there is good control there. In fact, some of the delinquencies are even improving. So first of all, overall on the industry retail book, Lata, I think there is good stability. In fact, if you take auto loans, home loans, two-wheeler loans, all these products, in fact, there's even an improvement in the overall delinquency to start with, the latest quarter numbers. A. B, in unsecured consumer durable loans and credit cards, it's almost the same, or there is a marginal increase in delinquency. But when I say marginal increase in delinquency in some of these consumption products, one has to keep in mind, on balance, two factors. One is we had the severe heat waves in April, May, which definitely affect collection efficiencies. And B, also remember the point earlier that in these products, the new product growth is slowing down, the growth rate. So to that extent, delinquency percentages also will be a little higher, because now you have a situation where for 2 or 3 quarters, the rate of growth of the delinquency or the numerator will be more than the rate of growth relatively of the book size. So 1 or 2, 3 quarters, we will see that normalization process.
Okay, so total number of loans given is less in that category, and therefore the delinquencies as a percentage will show up higher, is what you're saying.
Absolutely, yeah.
Right. Okay, you know, last time in the January 2024 press release that you all gave us upgrade, downgrade numbers.
Yeah.
And, you know, even in prime quality loans, there was the amount of prime was declining. You had a slight increase in the downgrade numbers in September 23 compared to the previous quarter.
Yeah.
Would you be able to help us, you know, whether upgrade, downgrade ratio is in favor of upgrades?
It's absolutely consistent and stable, Lata, between the overall upgrades across the industry. And then when I look at delinquency rates, particularly, you know, within each band, say above prime, prime, subprime, etc., these categories, within those categories, again, it's pretty much stable. And normally, I wouldn't want to kind of worry too much when there is a 10, 20, 30 bips difference. Those are seasonal and they kind of normalize pretty soon. I would only if sustained over 2-3 quarters, the dimension of the change and the direction of the change is negative. The good news is that as of now, we don't see any such trends. Latest quarter, credit cards saw a 20 odd bips increase in delinquency, again expected. And credit cards specifically, I think, is a slightly different issue. There is this growing hypothesis that a lot of the good spends of credit cards have moved to the UPI world. So to that extent, some increase in delinquency in cards is kind of expected. But again, I think there's a lot of normalization process there. And lastly, since we're talking about portfolio quality, Lata, like I said, the latest quarter origination plays an important role in the growth of the book size. Likewise, when we talk about delinquency, I think it's very important to look at two factors. First of all, the early delinquency, right? All the recently acquired books, how are the delinquency trends? Because when the book is new, if it shows early signs of higher delinquency, then we know what we are heading for. Again, good news there. The early delinquency percentages are pretty much stable and consistent across products. Like I said, again, just some 20 odd bips increase in credit cards. And likewise, when I compare different vintages, when over the past few years, when the loan books were 3 months old, 6 months old across products, what was the delinquency, let's say 30 days past due at 6 months vintage, 2-3 years back versus now? I don't see anything alarming at all. Like I said earlier, the theme remains all secured products, good improvement, marginal increase in a couple of these small ticket products, which I think will normalize soon.
Okay. There is one last fear that I want to check with you, that younger cohorts of borrowers are actually borrowing money on their personal loans account or credit card account and playing the stock market. You know, there is enough data that investors in the stock market are of much younger age, and those in FDs and mutual funds are older. Do you notice more delinquency in the younger age groups?
Actually, I haven't seen any marked change on an age cohort, Lata. And as to your earlier point about more investments into the market, etc., unfortunately, while we hear about these from the industry folks, CIBIL doesn't have visibility to the end use. And of course, unsecured loans, it is difficult indeed to monitor the end use. But coming back to your question on the younger cohort, we haven't seen any specific increase in delinquency because of a younger age group. But that does bring me to another point in turn, which is kind of linked. That new to credit, so the overall share of new to credit customers in new originations has come down significantly. I think perhaps because of some of these apprehensions, these are all early trends, and I think everybody's watching closely. And so share of new to credit has come down. That for me is worrying in a different way, because given our country's demographics with 70 crores population below the age of 28, very low credit to GDP ratio, very low house, home, two-wheeler, car ownership in India relative to the developed countries, etc. Given all of that, if new to credit comes down, so to give you a number, the share of new to credit customers in new originations used to be 12, 13, 14% about 12 to 18 months back. That has dropped to 6% now. So we're doing half the number of loans that we used to do to new to credit. So clearly conservative. And that's what, when I began our conversation, I was saying there's a little bit of resetting of risk appetite and product mix. Okay. And typically when you reset your risk appetite, you want to go easy on the small ticket, perceived higher risk, higher return products. A. B, you want to be a little more careful on approval rates. C, you want to be careful on new to credit because there's lesser information to confirm the probability of default, etc. So new to credit has reduced significantly. Okay. And that will in turn pass on to the younger population, inevitably.
We are running that data. Auto loans, for newly originated loans, it was 9.8 year ago. Now it's 1.5. I mean, down the line, the new to credit has clearly decreased. So the big worry for the industry should be that growth may be affected because of higher caution and not worsening of quality. Just a very quick, short answer from you. You know, you've looked at credit quality over the years. Are we at worry zone at all, or are we at the best of times?
Oh, not at all. Definitely not in the worry zone, Lata, because in fact, when I talk to all my industry friends, we say over 20 years, the kind of ratios we've seen. So that's why I keep telling everybody, including in my teams now, that whenever we talk these numbers, let's put a column next to it to say, what's the long-term average? Right? Yep. Are we well within the range, or in the long-term average, we are in fact more near the bottom end of the long-term range. So which is good news.
And where are we?
We are more close to the bottom end of the long-term range. Okay. So that's why I am not excessively alarmed. And things like a little bit of an increase in a few products like unsecured, this is the nature of the business. It's a lending business. We are going to see some opportunities. All of us will want to go do business there. It will lead to a little bit of over leveraging. The regulators and the risk management will kind of slow that down. And again, we moderate that. That's a cycle, but absolutely not in the worrisome range at all. Nowhere close to that.
Okay. Thank you. Thank you very much, Rajesh, for putting investors and financial market experts and regulators at ease. We are at the bottom end of the asset quality problem. So not to worry about asset quality, maybe a little bit of worry that loan growth may suffer because of excessive caution. On that positive note, we wrap up on Bazaar. Thank you very much for joining us. Chartbusters coming up after a break.